Good evening. My name is Brian St. Paul, and I'm the Director of Marketing here at Pinnacle Advisory Group. We'd like to welcome you to this evening's special webinar, Planning for the Fiscal Cliff. The presentation will be broken up into three sections. First, Michael Kitces will speak for about 30 minutes about the tax and planning issues that surround the approaching cliff. Then Rick Vollaro will talk for 10 to 15 minutes about what we can expect from the market, and then we'll take 10 minutes for questions. On that last point, if you have any questions during the webinar, please type them into the question and answer window on the right side of your screen, and we will try to get to them at the end of the webinar. So let's meet our presenters. First, we have Michael Kitces, a partner at Pinnacle and our Director of Research. Michael is a leading figure in the financial planning industry. Financial Planning Magazine described him as the profession's deep thinker, and he was also the recipient in 2010 of planning's most prestigious award, the Heart of Financial Planning Award. Michael is the practice editor for the Journal of Financial Planning. That was a position that was created specifically for him. And not surprisingly, given his recognition in the field, Michael is quoted frequently in the press. In fact, you might have seen him in this morning's Wall Street Journal in an article on long-term planning. Rick Vollaro will be handling the investment portion for tonight's presentation. He's a partner and the Chief Investment Strategist here at Pinnacle. That means he's responsible for all aspects of our portfolio management, and he leads our investment team. Rick is an in-demand conference speaker and panelist, and just returned last week actually from an appearance at a conference put on by Standard & Poor's. So with those introductions, we begin with Michael Kitces.
When we originally had scheduled this webinar quite a few weeks ago, I think we had figured and hoped that we would have a little bit more clarity right now. If we wind back 2 years ago, by the time we got to this point, December 17th in 2010, we had already figured out what the fiscal cliff of the time resolution was going to be and had passed a tax relief act that had extended us forward 2 more years to the point that we're at today. Unfortunately, though, it hasn't quite gone the same way this time around. And so while we had these sunset provisions that were originally going to take effect in 2010, that were going to push us back to where we were in the pre-2001 laws, and we had this resolution for 2 more years. As we're going through it now, we're still looming with 2 weeks left to go in the year and still not knowing where we're standing and what's likely going to happen heading into the next year. So my goal in our discussion here today is to really look at what some of the potential outcomes are between now and the end of the year, some of the possibilities that are out there for legislation and legislative compromises, as well as what unfortunately is still the looming risk that we may go entirely off the proverbial cliff and deal with a full lapse of the tax laws back to 2001, and talk a bit about some of the planning opportunities that are presented. Now, the theme for a lot of this is essentially going to be a series of kind of if-then conversations and discussions. If we have this version of the outcome, then we can do these planning strategies, and if we have this other version of the outcome, we can do something else. So unfortunately, it's a little bit messy. And it gets messier because on top of all of the legislation that we're talking about here, we also have a new tax that we have to contend with next year as well, entirely separate from the fiscal cliff. The new Medicare tax on unearned income begins next year. Now, this was established as part of the Patient Protection Act, or what we, I guess, fondly call now Obamacare. And the idea of the tax was it is a new 3.8% tax, applies to individuals as well as trusts, and it applies on essentially net investment income, so income we earn from various portfolio and passive investment activities over a specified threshold. And the threshold is the similar number that we've heard bounced around quite a bit lately, $200,000 for individuals and $250,000 for married couples. These are not indexed for inflation. They essentially represent what we at least called in the legislation the defining line between those who are, quote, wealthy and not. And the idea of the tax was to apply an additional portfolio tax for higher income individuals that would be assessed on any kind of investment income. And the investment income for this tax is construed rather widely. It includes interest, dividends, distributions from annuities, rents, royalties, any other kind of passive business, so passive real estate investing, investing in horse farms and horse breeding, anything that is a passive business is subject to the tax, as well as any form of capital gain. And so virtually anything that's out there that gets classified as investment income, if it's investment income and you are over these thresholds, you face a looming 3.8% tax increase on top of anything else that we're going to be discussing this evening. There are, fortunately, a couple of important exceptions to this. It does not apply for any income that is otherwise excluded in the first place. So if we have things like municipal bond interest, which is not subject to taxes in the first place, it's not subject to this tax as well. Any gains that are excluded are also excluded for this purpose of the tax. So for instance, we get a capital gains exclusion of up to $500,000 for a married couple on the sale of their primary residence. If the $500,000 of gain is excluded, it's not subject to the tax. On the other hand, if we had a gain even larger, if we had, say, a $700,000 gain for a house we've lived in for 30 years here in the area, the first $500,000 may be excluded, but the last $200,000 can potentially be subject to the 3.8% tax if you're over the income thresholds here. There is a specific rule that stipulates that any kinds of distributions from retirement accounts, so our IRAs, our Roth IRAs, our 401ks, our pension plans, etc., none of that income is subject to the 3.8% tax. But the caveat that we have to deal with even for this tax is while it is not directly subject to the tax, if we have a large IRA distribution, we may end up with income that rises so high that we cross over the threshold amounts here, which causes all of our other portfolio income to be subject to the tax. So we're going to deal with this in a lot of different ways. And one of the planning strategies you'll be hearing a lot more from us about as we're heading into 2013 and beyond are a lot of year-to-year planning strategies that we'll be engaging in to try to manage this tax from one year to the next to make sure we stay under the threshold amounts to the extent possible to minimize the amount of taxes that are due. The unique opportunity that we have between now and the end of the year, though, is this itself, this next 2-week period, represents what for many of you may be the last window we're going to have for a long time where you're not subject to this 3.8% tax. And so as we'll talk a little bit later about capital gains in particular, we have some unique opportunities between now and the end of the year to avoid this tax for what may be the last 2-week window before it applies for the indefinite future. Now, beyond the Medicare tax, we have some of these issues, the fiscal cliff itself. Now, the first one, and certainly one of the ones most widely discussed in the media, has been this potential lapse from what I give you on the left, which are our current tax brackets as they exist right now, and the brackets that you see on the right, which essentially are the new tax brackets. And of course I write new tax brackets in quote, because the reality is these are actually the old tax brackets that applied when President Clinton left office and President Bush came into office 11 plus years ago. And so as you can see from the chart, no matter where you are on this chart, you face a prospective increase of about 3 to 5 percentage points. Our 10% bracket goes to 15, the 25 goes to 28, down to the 35 goes to the 39.6. Wherever we are, we face a 3 to 5 percentage point increase in tax rate. The only exception to that, as you may note in the middle, there is a 15% bracket now and a 15% bracket next year, although technically the 15% bracket next year for married couples gets smaller because of some separate provisions that are scheduled to lapse. So some 15% income will actually end out in the 28% bracket next year. So wherever we are, we face this potential lift in tax rates. Now, the good news overall, while 3 to 5 percentage points does certainly take a bite, it's not literally the destruction for most people's retirements. It means for every $100,000 of income, there might be $3,000 to $5,000 of extra taxes due. It's certainly painful, but not in and of itself likely to ruin long-term retirement projections. That being said, it presents significant planning opportunities at the margin. Because if we look at this and break it down to individual dollar amounts, we imagine that we have $10,000 of income subject to the 10% bracket this year. Our tax bill this year would be $1,000. If we hold on to the income for a few more weeks and recognize it next year, we're subject to a 15% tax rate and $1,500 of liability. And so literally in the next 2 weeks, our tax liability increases by 50%. We go from $1,000 to $1,500. Now, as we go to higher tax brackets, the relative increase is not quite as much, but wherever we are, we face these tax increases that at the margin lift our tax obligation from about 10 to 50%. What that means is it's not necessarily a very good deal to defer income into next year because, quite literally, in order to make it a good deal, we need to grow the money by 10 to 50% in a matter of weeks in order to make income deferral favorable. So what we see occurring instead is a series of income shifting transactions that look very different than our traditional world of tax planning. The traditional world of tax planning, we've all learned, is pretty straightforward. You take every deduction that you possibly can immediately because we don't want to pay any more taxes to Uncle Sam than we have to, and we defer every dollar of income down the road as far as we can because if we do have to pay taxes, we don't want to pay them any sooner than we have to keep our tax dollars working for us and growing. Well, the challenge that we get into in an environment like this is the optimal strategy actually becomes the exact opposite. In a rising tax rate environment, you actually want to accelerate the income and defer the deductions. Take the income this year at this year's rates because we can't grow it enough in just a few weeks to make it worthwhile to delay. And similarly, we actually want to defer our deductions because ultimately our deductions are only as good as the tax bracket against which they apply. If our tax brackets actually rise next year, our tax deductions are worth more if only we wait until next year. And so that leads us to a lot of strategies ranging from accelerating income into this year, doing Roth conversions, taking any IRA withdrawals now that we need to fund our spending for much of next year and getting it done immediately. And similarly, deferring deductions. That may mean some of our checks we write perhaps to charities at the end of the year here, we actually get more value out of it by writing it the day after New Year's instead of the day before. Now, the caveat to all of this is the risk of tax reform and these discussions that are bouncing around where maybe we're going to have reform where we eliminate most of the tax deductions and in exchange for having lower brackets, which ironically and unfortunately switches us back to our traditional tax planning where we delay our income and accelerate our deductions. So this becomes one of the several areas we're going to talk about where the compromises that do or don't come forth in the next 2 weeks here will really dictate what kind of activity you may want to do in the last week of the year to either accelerate your income into the year or to accelerate deductions into the year, depending on which way the negotiations are going. Now, we face a similar challenge in terms of capital gains. Our current capital gains tax rate is a maximum rate of 15%, and it's actually 0% for those who fall into the bottom two tax brackets. Now, just a clarification here because we see some confusion about it sometimes. That doesn't mean if your income is in the lower brackets, you get an unlimited amount of capital gains at 0% rates. What it actually means is you get a portion of your gains. So we give you an example here where if we have $20,000 of ordinary income and $60,000 of capital gains, the first $20,000 of ordinary income, the blue box here, gets taxed at the bottom brackets. The next $48,000 of capital gains, the green box, which would fall in within the threshold for the bottom two brackets, gets taxed at 0%. And then the last $12,000 of gains, and really anything above that, whether it's another $12,000, $50,000, $100,000 or more, is all taxed at our normal 15% capital gains rate. So it's not an unlimited opportunity to take capital gains at 0%. Nonetheless, it's a very significant opportunity as saving 15% tax rate on a $48,000 gain is $7,200 of actual taxes that we save and we don't have to pay. Now, in terms of what happens next year, here too we see a rather significant increase scheduled. The 15% rate goes back to 20%, the bottom 0% rate goes back to 10%, and we actually bring back rules for what are called ultra long-term capital gains, where if we hold not just for 1 year but 5 years, we get a little 2 percentage point break where the rates are 18 and 8. Nice if we get it, but probably won't be something we're going to hold 5 years for just to try to get an 18 and 8% rate. Nonetheless, the underlying issue here is, once again, we have this rising tax rate environment. Our tax liability on a $100,000 capital gain is $15,000 this year and $20,000 next year, which again means we have to grow our money by 33% between now and next year to make waiting on capital gains a good deal for anything that might have been sold next year. And in reality, we need a more than 33% gain because, of course, if it went up, we would owe taxes on that. And by the time we owe our taxes on our taxes, we end up needing an almost 42% gain. It's worse if we go back to the Medicare tax that we had noted earlier. For those of you that are above the $200,000 and $250,000 thresholds, your capital gains rate potentially rises from 15 to 23.8. Now suddenly we need a 70+% rise in just a span of 2 weeks in order to make deferring capital gains a good deal. So what this actually takes us to is a very strange environment. Most of us are familiar with the idea of harvesting capital losses. We've done this for many of you year after year at the end of the year, where we sell positions that have losses and take advantage of the losses and the tax deductions that are associated with it. But again, claiming losses and deferring income is what we do when tax rates are even. When they're rising, we actually want it to turn around. And so the primary thing that we've been focusing on heading into the end of the year here is not harvesting losses, but actually harvesting gains. Now, the good news is harvesting gains is easier. We can actually sell the position and simply buy it back immediately. We don't have all of the complicated wash sale rules that apply for losses. So you're going to hear a lot of discussion from us, and you heard some of it already, about harvesting gains here at the end of the year. Now, again, this is still a looming issue of what exactly happens with the fiscal cliff, and so it depends a little on the situation that you're in. For those of you who are high enough in income that you're going to face the new Medicare tax next year, even if we extend the rules as is, the tax rate still goes from 15 to 18.8. That requires a 20+% increase in prices over just the next couple of weeks. Not very likely, and so for anyone that is at upper income levels, the best deal on the table right now is to harvest gains. Literally, we sell the investments, buy them back immediately, remain invested, but you have the capital gain, and you voluntarily pay the taxes because you still pay a lot less in taxes to do it this year than you would have in the next year or two. For those of you who are have enough deductions or controlled income that you're actually able to stay in the bottom two tax brackets, we also find the capital gains harvesting appealing for the simple reason that your tax rate is zero. So in essence, we can get a virtually free step up in basis. Now, by the time we deal with all the other interactions on your tax return, your rate usually isn't a perfect zero, but it's 1 or 2%. And so in practice, since it's hard to do better than 1 or 2%, we're also looking very actively at capital gains harvesting for those of you in the bottom brackets. For the rest of you in the middle, which for couples essentially means income anywhere from $70,000 to $250,000, it's again going to be very much a wait-and-see approach between now and the end of the year. If it looks like the fiscal cliff is going to occur, we'll be looking to harvest capital gains. If it looks like the fiscal cliff is not going to occur, then we would actually revert back to harvesting losses. Now, the one scenario where we're still looking at not harvesting gains, aside from simply having the rules extend as is if we have capital loss carry-forwards. Unfortunately, the rules say we have to use our gains against our losses. We can't just take the gains at today's rates and keep the losses till next year. So if we have loss carry-forwards, we're actually looking at not harvesting gains. We'll simply hold on the losses, use them next year at higher rates, and proceed forward. But for most of the rest of you, harvesting gains is really the opportunity on the table right now. It doesn't necessarily mean we'll harvest gains for something that we might have held for 10 or 20 years. We can still get the value of tax deferral from that. But anything that might have been sold in the next couple years, there's actually a significant opportunity for tax savings on the table now by harvesting gains and not waiting. Now, we see a similar scenario emerging for dividends. Under the current tax law, we have what's called qualified dividend treatment, which means essentially if it's a qualified dividend, which means the publicly traded stock as a C corporation, and we meet a holding period requirement, which is simply 60 days before or after the dividend date, 90 days for a preferred stock. If we meet these requirements, we get what's called qualified dividend treatment, which simply means our dividends are taxed the same way as our long-term capital gains, and we get the 0% and 15% rates. Next year, this too lapses, but the potential lapse is actually much more extreme because dividends are actually scheduled to go all the way back to ordinary income rates, which means we go from a top dividend rate of 15 to a top tax bracket, which is 35, which goes to 39.6 next year. And if you were actually in the 39.6% bracket, you would have the 3.8% Medicare tax as well, which takes you to 43.4. And with a few other phase-outs that come back next year, we essentially go from a top dividend rate of 15 to 45 next year. It is a huge increase in prospective dividends. And it is one of the reasons why you may have already heard some discussions in the news about several major corporations, including Walmart, choosing to pay so-called special dividends before the end of the year, because even a lot of large businesses are looking to distribute their dividends out before the end of the year to make sure they get them at this year's rates rather than the potential for significantly higher net rates next year. Now, in terms of the portfolio, this is going to, we think, lead to a lot of reevaluations from investors across the marketplace about whether they really still want to hold dividend-paying stocks in an environment where dividends are taxed this heavily. Now, to be fair, not everybody is subject to rates as high as 45, both because not everyone is in the top tax bracket and because many dividend-paying stocks are held in retirement accounts by institutions and in other environments where these sorts of taxes are not a driving factor. So it doesn't necessarily mean that we're going to have some catastrophic decline in the value of dividend-paying stocks over the next couple of weeks, but it does mean we expect not only some headwinds towards dividend-paying stocks in general, but that it's really going to merit a reevaluation of the worthiness of dividend-paying stocks and portfolios overall. Now, Rick will speak a little bit more later to how we're looking at this from the investment context, and really the short answer is we have always managed portfolios viewing the stock in its entirety, including both its dividends and its potential for appreciation, and not just buying stocks that pay dividends for the sake that they pay dividends. But for investors that do, we expect to see a lot of reevaluations of whether they want to keep holding their portfolios as is. Another opportunity that's out there for a few of you is for those of you that have closely held businesses that are actually structured as C corporations, so the same corporate structure as large publicly traded corporations. There's an opportunity also to do these kinds of dividend harvesting strategies. If it's a large major corporation, unfortunately, we're kind of beholden to the corporation. Either they decide to give the dividends out before the end of the year or not. When it's our business, though, we actually get to control it. And so the conversations I know we're having with a few of you already and reaching out to a few more of you is whether we want to look at taking money out of businesses between now and the end of the year, specifically to take advantage of these dividend rates as a small business owner. Now, obviously, we have to be careful in that in weighing the implications for the business of taking cash out versus the tax treatment of extracting dividends. But nonetheless, this is the planning opportunity and issue on the table because the rise in taxation between now and the end of the year is so significant, especially for dividends. Now, one of the other areas you're going to hear more discussion about over the next 2 weeks is the alternative minimum tax. Now, the AMT is a little bit different. All the tax rules we're talking about so far are things that lapse at the end of this year, which means technically your rates would be higher for 2013, and for many of you, you wouldn't really feel the pinch on your wallet until 2014 when you began to do your tax returns in the first few months of 2014 for the 2013 tax year. AMT is a little bit different, though. Unlike everything else that got extended from 2010 to 2012, technically when we passed the law 2 years ago, the 2-year extension from the AMT was retroactive for 2010 and forward to 2011. In other words, it was actually a 2-year stretch that went back to 2009. So where we stand right now is the AMT exemption, this giant deduction that we all get for AMT purposes to avoid being exposed to it, has already dropped significantly, nearly $30,000 for married couples with a 26 to 28% tax rate. That essentially costs us almost $6,000 out of pocket simply because the AMT exemption is already moved. And according to the Tax Policy Center, this is already a potential shift of 25 million taxpayers into the AMT. For most of you who are here in the area, the Baltimore, or I should really say the Maryland, D.C., Virginia region, our state tax rates alone make it almost impossible to avoid the AMT at these levels. So you're going to hear a lot of discussion about the AMT over the next few weeks here. Now, ironically, the good news, while being subject to the AMT quite literally means your tax bill is higher, the whole nature of the system is to make us pay more taxes, at the margin, it can actually be good news because the top AMT rate is 28%. That's as high as it goes. And so if we're looking at rising tax rates that could be as high as 39.6 or higher next year, depending on the type of income, we actually are looking at some scenarios where we would do things like Roth conversions, IRA withdrawals, or other strategies to accelerate income into this year because we actually want to take more income when you're subject to AMT because 28 actually is not a bad tax rate at the margin. Keep your eye on this, and we'll certainly be keeping our eye on this. The AMT is a very popular item to negotiate on and try to come to compromise on. Neither the Democrats nor the Republicans want to see us go off the AMT cliff in particular because of the huge number of people it affects that are predominantly middle class. The lapse here essentially impacts people from about $75,000 of income up to about $500,000, which is sort of the wide swath of middle class, middle income, up to small business owners. So there's a lot of interest in avoiding this scenario. Unfortunately, fixing the AMT just for 2012 alone is estimated to be approximately an $80 to $100 billion tax cut retroactive to the beginning of the year. So it's very expensive for Congress to do this, which is why they haven't been able to come to conclusion yet. Now, as we look at this heading into the end of the year, again, just to recap a little of this, our strategy for rising tax rate environments, and what really begins to work, are accelerating income and actually holding off and deferring deductions into next year. So we would look at things like Roth conversions and IRA withdrawals between now and the end of the year, and then doing our deductions, whether that's our estimated tax payments for the end of the year or even things like charitable contributions into early next year. The looming caveat to that, again, is that compromise could potentially not just extend our current tax rates going forward, but the potential for tax reform heading into next year that eliminates deductions and brings rates down means we will really be listening to what happens over the next week or two with compromises out of Washington or not, and what sort of shape they seem to be taking to get some idea of whether tax reform is really on the table from the Republicans and the Democrats to find compromise next year, or whether we'll either go off the proverbial cliff or come to some moderate compromise and simply say this is where we are for another 2 years, and we may still end out with another 2-year extension as we did in 2010. So depending on what that outlook appears to be will really dictate what's going to happen in terms of tax planning over the next week or two here. In terms of capital gains harvesting, again, this is really going to drive off of where our tax brackets appear to be heading now versus the end of the year. If you are in the lowest brackets, where you can get 0% capital gains rates, we see little harm in going ahead and harvesting gains now. If you're on the top tax rates and you're going to be subject to the new Medicare tax next year, similarly, there's almost no downside we can find to harvesting capital gains. It just outright saves you tax dollars over the next 2 to 3 years. For those of you in the middle, it again is going to be very much a wait-and-see approach as to whether we really appear to be heading off the cliff or not, which will determine whether that 15% rate is going to 20% for everybody from about $70,000 to $250,000 of income. If it appears it's going to happen, we'll be looking to harvest even more gains next week for everybody else. And then again, in terms of dividend changes, for a lot of you in terms of portfolio changes, we're simply going to be monitoring this as part of our ongoing investment process. Although if it does appear that we want to eliminate any positions because of dividends and the changes to dividend tax law, we still may well try to do it right here at the very end of the year and actually choose to do it this year because, again, if we're going to make changes anyways and the position is appreciated, we would rather have the capital gains occur this year and not next year. And for those of you who do have closely held C corporations as a small business, there's still a discussion left to be had about whether we actually want to pull money out of the business between now and the end of the year and take advantage of the tax rates while we can for what may be a dwindling window that soon disappears. With that, I'm going to go ahead and turn it over to Rick for a little bit to talk a bit about the markets, and then I will be hanging around and we will be available at the end, both Rick and myself, to answer any questions that you have about either the planning strategies here or I guess any prognostications you want to ask us about in terms of what kinds of compromises may or may not be coming from Washington. But for now, I'll go ahead and turn it over to Rick.
All right, great. Thank you, Michael. And great job as always. We can always learn something about financial planning from Michael Kitces, so it's a never-ending education listening to the man. But I get a chance here to talk for a couple minutes now about what this fiscal cliff really means for the markets. And I'll start by just setting it up and saying that I think we can all agree that the fiscal cliff has really been an all-out 24/7 negative barrage by the media right now. And we're all getting to the point here where, if we hear fiscal cliff one more time, we all want to just, get sick. But I wanted to share with you, just a feeling with that. Today we had a note from one of our strategists that we follow, Dr. Ed Yardeni. Some of you might know his name. He's on Bloomberg and CNBC a lot. But he reminded us this morning that, the fiscal cliff really wasn't the thing that we needed to worry about. In fact, we needed to worry about the Mayan calendar that says, this Friday the world will come to an end. And the best part about what Dr. Ed said was that if it did come to an end, we would no longer have to worry about falling off the fiscal cliff at the start of next year. So I think that sort of represents the sentiments that most of us have out there in terms of the fiscal cliff at this point. But the reality is we need to, we can't ignore this. It's a big deal for financial markets as well as your financial planning situation as well. So let's take a look for a minute Michael just explained in detail, I think, really what this slide is saying in terms of why the cliff matters. But from a pure investment standpoint, I think to get to the bottom of it really just gets down to the business cycle that we watch. And the reality is if we got the full effect of a cliff, if we went off the full cliff next year, and you can see at the bottom of the chart, the cliff is estimated at $719 billion. You're going to get different references, every article you read, but let's just assume somewhere between $600 and $720 billion is about right. And the full impact of that could be about 4.5% drag on GDP. So for us, what does that mean? It means that this thing could put us into recession next year. In fact, the Congressional Budget Office, they've already done the numbers, and they projected for a full year this would drop about 0.5 percentage point off growth, and for the first quarter it would be pretty steep, somewhere close to 3%. So, the reality is for us as investors is we sit here and say to ourselves, if we're actually going off the full cliff, we're going to have to change our base case right now because we are not invested for a cycle change here in the U.S. to occur. But the reality is we have to come to a decision about what the cliff is actually going to mean, how it's going to resolve itself. Unfortunately, we don't get the luxury of deciding that we can just wait. We have to have a base case. And at the moment, I would say it's safe to say that our base case here, where we have an Obama presidency and a split Congress, is that we're going to get some headwinds, but that you're not going to get a full cliff. You'll likely get a muted cliff. This chart is admittedly a little old. It's basically the same chart you just showed outlining the $720 billion, but just with some different guesses on there as to what's going to be extended, what's not going to be extended or repealed. And I think it's safe to say that most of the things we're reading are saying that the most highly probable scenario is that at the end of the day, we'll likely get to a deal. Yes, that deal will be a headwind, but it's not going to be a full 4.5%. Okay, so let's assume that that's the case, because that is our base case at Pinnacle at the moment, that eventually politicians will understand that their constituents did not vote them in to put us in deep recession. So, next question that we have to ask ourselves is can we sustain even a moderate hit to the economy? So if we get a 1 to 2% hit next year, a drag on growth from the fiscal cliff, can we handle it? And I think normally this might not be that big a deal, but we all know that we've been running at sort of low altitude. And this chart here just shows you a real GDP trend line for U.S. GDP growth since the 50s. And on the bottom, you get to see kind of a standard deviation line. And what it shows you is that kind of what everyone knows. We've been in this new normal, growing at a subpar rate of growth. And at the moment, certainly we could be vulnerable to even a 1 to 2% hit if nothing else changes or gets better. So what do we think? Well, we think at the moment that economic growth should hold. Why? There's some different reasons why we think that growth can hold if we get just a moderate hit to GDP as opposed to a full fiscal cliff hit. I'll go over a couple of them. I've got the 3 C's listed out here: consumption, credit, China, and then there's some other things to be worried about. Number one, the consumer here, that's still 78% of the GDP, is held up quite well. In fact, if you look at retail sales reports out of the last few months, they've actually held up pretty darn well here. In fact, I read a number yesterday that would equate current retail sales numbers to clock in at about a 4% hit for consumption. And if that's 70% of the economy, that could be a 2.8% rate of growth right there off of consumption. So consumption actually looks like it's holding up quite well. Credit conditions are doing extremely well. The auto markets that have been depressed for quite some time are beginning to come back. The housing market this year has gone back and has a big multiplier effect on the economy to the positive. State and local drag that's been a drag on our economy for some time is beginning to abate. Jobs look pretty solid. And I think the key is whether or not next year, if we can get by this cliff, if we can get some of the uncertainty out of the way, maybe the big C that's not even listed here is capital spending. Capital spending by businesses is one of those things that's really been subpar during this upturn. And perhaps with a little more clarity here, businesses will feel pretty good about the future and begin to spend a little bit. The last bullet there is China, and I'll just say as we look at the globe and the 3 economic engines, really if we decide that the U.S. is going to hang in there and even continue to produce somewhere around a slow growth profile. We know the Eurozone is in recession at the moment. However, we think that perhaps it's past the worst of its rate of change, and maybe we're stabilizing next year. And very encouraging lately is the fact that China actually is beginning to look like it's starting to turn up. So, many quarters that China had, somewhat of a rough patch. They've been decelerating in terms of their growth rates. But recently we've seen a couple of PMI numbers or sort of growth barometers that are ticking up. And we're starting to see some different data that's starting to support the case that, after multiple reserve rate requirements, after cutting rates, after suppressing their currency for some time, it's starting to look like growth is coming out of China again, and that's good news. So we think the economic growth engine can hold as long as the hit is somewhat moderate. Looking beyond the cliff, there's some other things in the backdrop that I think are supportive. I mean, number one, we could talk about monetary policy supporting growth. We know just recently, again, we had quantitative easing 4 now by the Fed, essentially adding some more bonds to be buying. So we're going to be adding about $1 trillion worth of bonds to the balance sheet. The Fed did something unusual this time around, decided to simply target growth. They decided that, we're going to keep pedal to the metal here until we get unemployment down to about 6.5%. I think we're at 7.7% now. Some are equating, that drop to be probably 2014, maybe 2015, so you could get to those levels. So you've got a supportive U.S. monetary policy. You've got supportive monetary policy conditions in China. In Japan, we just had a leadership change. It looks like supportive conditions there as well. The bottom line here is global support for growth here coming out of central banks around the world. Number two, I think there's relative, attractive valuations out there. And right now I'm really talking about the equity markets. So whether you look at sort of the relative valuations of cyclical assets versus defensive assets, or more importantly, if you look at some of the equity yields versus bond yields per se, I think the relative story still is quite attractive for the equity market at the moment and should support things going forward. Last thing I would say, again, is that the expectations or the hurdle rate going forward is pretty low. I mean, all of this negative news flow coming out of the cliff, for good reason, I think people are, pulling down their projections, their growth rates, their expectations for earnings. And I think the good news for that, again, is going forward is that it just leaves a low hurdle rate. So if we can simply hold in there on the U.S. with very supportive monetary policy, there's no reason earnings can't do reasonably well next year. And so that, again, sets up, we think, a reasonably constructive backdrop here. What about the uncertainty? I mean, the reality is that we're sitting in the lame duck negotiation period here. Every day, what do we get? We get, a comment from Boehner or the president. It's back and forth. And the questions are, multifold here. Will we fix this by year end? The honest answer is we don't know. I mean, hopefully we get a deal, before the end of the year, and that could maybe get a little pop to the markets here. But there's no guarantee. I mean, this may easily drag into 2013, where you'll have other things like the debt ceiling back on the table. And, should that occur, all that's going to produce is probably some more volatility in the market. So the reality is here we're into an uncertain period ahead. We still think the deal is going to get done. In the interim, you may have some volatility to deal with, and that's kind of how we're positioning the portfolio. So, the reality is we're hoping that the deal gets struck this year, and that could produce really a major relief rally, we think. Some of which, I quite honestly, you have to ask yourself every day, is it happening now? A day like today, again, not a lot seemingly happened, but the markets moved 1%. We're back up to 1430 on the S&P, about 45 points shy of the high back in September. So the markets are moving constructively as if a deal is going to get done here. We still think if the deal gets done, that would be good for some sort of a relief rally. If nothing gets done by year end, perhaps more volatility to come. So what do we do then? Should we go to cash here, get very defensive? Should we stay very aggressively positioned? No, we don't think either way. I think at the moment, the right course of action for us is that it's not a time to make a big allocation bet. Now, that's where we've been since really the second quarter of this year. Just saying again, there's too many unusual things going on in the world to make a huge allocation bet, and we still sit in the same place. So we're going to be around a benchmark level of volatility here, give or take a few basis points. And we're going to hold some hedges. So we have quite a few hedges in the portfolio, everything from gold to the U.S. dollar to long-term treasury bonds to some volatility indices that we have in the portfolio. And we think right now is a great time to hold some hedges just in case our base case doesn't come to fruition. And number three, and most important, we have to stay flexible. Because just because we have a base case that seems reasonable that politicians will eventually come to a conclusion that isn't draconian, if you will, you never know. Policy mistakes happen, and we have to be flexible enough to change with the actual facts on the ground. So at the moment, no big bets, hold the hedges, and just continue to watch and stay flexible to what actually comes out of these fiscal cliff negotiations. And then lastly, I just want to give you a little bit of insight into another theme shift I think that's going on in our portfolio. So looking beyond the cliff here a little bit, although maybe it's somewhat tied in, is that lately you've seen some positions over the last few quarters in your portfolios on the international side that are beginning to build. And I think really going into 2013, that may be one of our big themes in terms of beginning to shift back to global. So the last couple of years, it's clearly been good to be in the U.S. It's been a nice trending trade versus the international markets. But the question is right now, are we seeing some things here that would lead us to believe that that trend might shift here, and bring us back to global being a place to be that would be beneficial for us. So we think so. I mean, I think a number of things are out there that make this a positive theme for us. Number one, we think international value is built. So whether it's in Europe, where a whole lot of international value is built, we've already begun to build positions, whether it's in the emerging markets that have also had a really tough time over the last few years. I mean, I think we really did a pretty good job of sidestepping a lot of the volatility in the international markets over the last year and a half to 2 years. But now it's probably time to begin to, cherry pick some of the value that's out there. So you're going to see us building a little bit internationally. I think this fiscal cliff maybe this could become the catalyst for why the international markets look a little bit better. So value is great, but we always say it's not a great timing indicator. What could a catalyst be? Well, perhaps the catalyst is that all of a sudden the winds are shifting a bit, and even though the cliff will not take us over the edge, if you will, the cliff might be just enough headwind on growth here in the U.S. to tip the margin on a relative basis. So it could be that the cliff becomes a catalyst for the trend change between the U.S. trade into the international trade. So, with that, I'll just end on the fact that you'll see positions be building in your portfolios on the international level. No guarantees in terms of what and what the timing will be, but don't be surprised, from now into the next quarter or so if you don't see more international positions in your portfolio at the expense of some of the U.S. positions that we have in there now. And I think that's it. I guess we'll take some questions at this point.
Yes, if you have any questions for Rick or for Michael, please type them into your question window on the side of the screen. We received two during the presentation. The first person asked if this webinar will be recorded and made available, and yes, it will. We will be turning this into a video. We've been recording it, and we will upload this to our website on Wednesday. That's www.pinnacleadvisory.com. We will have the website address and our other contact information at the conclusion of this webinar, so you can copy it down directly at that time. We also had a question for Rick asking what is the percentage chance, in his opinion, that we will go over the cliff?
Let me hedge that a bit, because that's what we do here at Pinnacle. We hedge things. But, some of that just gets down to timing in terms of what you mean going over the cliff. If by that you mean could we get to 2013 and not have this resolved, I would say the probabilities are growing here that we could get there. Again, our base case says by sometime early into next year, and hopefully earlier, politicians will come to their senses and they will get a deal done. Now, to give you a percentage, on that, I'll give you the best I can. I'll give you an off-the-cuff 80% chance here of that happening at the moment. We think it's the high probability chance that a deal will get done. The exact timing, unknown. We'll just have to watch day to day to day. Hopefully the president wants to go to Hawaii, and he'd like to get this done before then. So that's the best I can give you. I would say now it's a high probability.
We have another question. What about the uncertainty in Europe, in Greece, and some of the other countries?
Good question. Something we've obviously been talking a lot here at Pinnacle for the last few quarters as we've begun to buy some positions in the Eurozone. I think that, at this point, the thing with Europe is that it's clearly ingrained into the markets now. It's in the market's muscle memory to look for things in Europe and find negatives out there right now. But I think, again, I do think that we hit a pretty big moment back when Draghi earlier in the year decided to go with the OMT program in terms of taking the entire balance sheet of the ECB and backing the system. So that was a very big deal. That will not save some of these countries structurally. To the positive, I do think that, again, some of the austerity programs that they've got going there and some of the headwinds coming purely from austerity and some of their drag are going to begin to abate this year. So our case for Europe is not really one that says you're going to get barn burner growth out of Europe. this year, next. It's one that says basically the markets have priced, a lot of the markets out there in Europe have been priced for a depression at this point. And so it's really one of these things that says the markets move on the rate of change, and to the extent all we really need to do is stabilize here. We've got very cheap assets out there in Europe. To the extent we can stabilize a little bit, that might be all you need for that trade at the moment. At some point we'll need to see better growth, obviously, positive growth. But I don't think we're there yet. It's almost like back in 2009 in the U.S., where for some time, the markets really rallied hard before any of that's why we've been willing to buy some initial positions into Europe. Again, because we believe there's good value there, it could be that we buy some more Europe.
We have a question for Michael. Michael, will the IRS extend the Roth conversion deadline from December?
Good question. So in terms of Roth conversions and just the timing of execution, we do have to do our conversions by December 31st. We have absolutely no indication that any of that is going to get extended in terms of the timeliness by when we have to do it. Now, there's also been a lot of discussion around, are Roth conversions going to go away, and are we going to lose the ability to do Roth conversions? That we really see no risk to whatsoever, for the rather ironic reason that in the short to intermediate term, people that do Roth conversions, where they take money that they might not have spent for 10, 20, or 30 years down the road and turn it into a Roth IRA with a tax liability now, means when Congress does its 10-year projections, and that's what we tend to talk about when we say things like we have a $1 trillion deficit savings by doing such and such a tax plan, it means $1 trillion over 10 years. If we were to remove Roth conversions from the tax law as it stands right now and eliminate all of the Roth conversions and the money that comes in the federal government, it would actually be scored by the Congressional Budget Office as a revenue loss for the government. So literally, if we wanted to get rid of Roth conversions, we would have to raise a tax to pay for it. That's just the way the math works out on budgeting for the federal government. To say the least, if they are able to get any tax increases done for those people in Congress who want to get some tax increases done, they're not looking to do so in order to pay for things like eliminating Roth conversions. So, the short answer is simply we do have to do our Roth conversions by the end of the year. We can unwind them as late as October of next year if we change our mind, but we do have to get them done by the end of this year. But we are going to continue to have Roth conversion opportunities for many years to come. It's not going away anytime soon.
Okay, this is Rick. I've got another one here. I'm just going to read it off. I thought it was a good one here that a lot of people might be asking. It is, does the tax brackets of your clients determine investment choices? Okay, so Pinnacle is a wealth manager. We also obviously have a lot of tax sensitivity going through our history and the DNA of the firm. However, as we position portfolios, we don't let the tax tail wag the dog, in effect. So taxes are important to us. But from a investment positioning, we're really worried about a total return of the vehicle, that we're buying. That being said, I mean, this is where you really get to the, a number of different things. We've got software that allows us to rank positions by their tax sensitivity. So, we do our best here to mitigate, any taxes that are unnecessary by simply, putting as many tax inefficient vehicles into deferred types of accounts that we can, and vice versa. Certainly our wealth managers are out there looking at every individual's situation and trying to determine what's best for them. But from the investment standpoint, the rest of the model portfolios are really run from a total return standpoint to try to beat inflation over time.
We have another question for Michael. Michael, I'm getting conflicting information about defined benefit plan mandatory withdrawals. Some say it is defined in the plan. Others say it goes by the normal IRA mandatory withdrawal schedule rate. Can you clarify that?
Sure. The general rule for defined benefit plans, if it truly is functioning as a defined benefit plan, is that the rules either under the plan document control, or if there aren't any, there are essentially some default provisions that the IRS gives us about what to do with pension plans that have not begun distributions yet. We have a separate set of rules that frankly look very similar for the normal required minimum distribution rules, but there is a slightly different set that applies for defined benefit plans.
Okay, this is Rick again. I'll take another one here. Do you anticipate a large drop in markets on the last day of trading this year, regardless of whether or not we go off the cliff? Interesting question. I mean, the reality is I wouldn't be surprised if some of the selling that we saw into November 19th wasn't a lot of people just hitting the trigger as soon as we had the election. People knew the rates were going up. They wanted to, take the gains they could, assuming that taxes were going up. Some of that's already been worked off, in my estimation. It's really impossible to know, once again, if we get to the end of the year here and nothing's done, if the markets are going to ride for a few days, maybe a week or two. Again, it may be that that's what politicians need to really get moving. I mean, whether it's Europe or here, I think that, over the last few years, what we've seen is that politicians really do pay attention to markets, and so do central banks. And that, when things begin to really pressure them, that's when they actually get some deals done. So, I don't know. I mean, looking at 2011 and what happened with the debt ceiling, for instance, there was a panic moment there. But I think in retrospect now, the right thing to do probably at the time was to take a longer-term approach, and buy that dip, based on the fact that it was highly probable that was a temporary event. And, well, again, while we could change our view based on the facts on the ground, in other words, if we got to 2013, and then it turned out that the actual deal that got done was what we felt much worse than we had projected, and it really was going to be a problem for growth, well, then we may have to just change, turn direction. But if there's just simply market volatility over the short term, I think that's where we're going to let the hedges do their talking. We've got about 13% hedges in a moderate portfolio, for instance, and that's where they should, make hay for us in terms of short-term volatility.
I see another good question here I want to cover quickly around high gains stock and harvesting gains versus doing charitable contributions. If we're otherwise doing charitable contributions, using appreciated stock is still a fantastic deal, and frankly better than the harvesting alternatives. The harvesting is a nice tax savings to save the current tax rate versus a future tax rate. Donating appreciated stock essentially avoids the capital gain permanently. That's one of the incentives that we attach to charitable giving to encourage larger gifts. So if we sort of had to rank these out in priority here, we would start with using the most appreciated securities for outright charitable donations first. If that's actually a gift that you're otherwise going to do anyways, you don't end up ahead by giving away the money. But if you're going to give away money, you get the most tax leverage from it by using appreciated securities. Then for things that we are not going to be donating, only then would we start actually looking at doing harvesting. So the charitable benefit actually still trumps the gains harvesting benefit that we've been discussing here.
Okay, I got another one here. With higher taxes and near certainty, will this hurt large value stocks paying 6.8 times current large growth dividend? What's the allocation outlook between growth and value going forward? Best thing I can tell you here, again, is the way that we sector rotate is really less about lining up growth per se versus value. And instead, again, we're going to start mostly with the cycle. So again, the cycle helps line us up in terms of, do we want early cycle items like, discretionary and technology and financials? Do we want late things like materials, energy, industrials, or do we want defensives like healthcare and staples and utilities and that sort of a thing? So we put a lot of pressure as we do our work on the business cycle, the actual valuations of the sectors and the industries that we're looking at, the micro fundamental catalysts, like who's got pricing power, are there any margin concerns in terms of what's going on? Are they raising their wages a whole bunch? It's going to set up a margin problem and a disappointment going forward, those sorts of things. So really, we're not going to look at broadly growth and value, generally speaking, and take that sort of a view. In terms of income stocks themselves, I'll just make a couple of comments on them, I guess. I think we are beginning to see some valuation dispersion now between some of the cyclical names and the income-producing names, if you will, for some time. And to the extent that, again, there's going to be tax rates going up, yeah, that could be a technical here that gets people selling them. We also have to keep in mind that, going forward, we're going to continue to be in a zero interest rate policy here, likely for next year and probably into the year after that, unless something changes dramatically on the growth side. So, as bad as they look from a tax perspective to some extent, they also look pretty good still from an income perspective, especially when you take into account, something like a safe treasury yield or even an investment-grade corporate bond yields you very little right now. So, not a hard stance either way there, but we'll continue to play the game really mostly on the other side of the coin in terms of looking at the cycle and the other things I talked about.
One more question that I see here. There was a comment, is it worth taking as much income as possible prior to 2013 in hopes that there will be a new tax solution in the first quarter? Yes and no. We're actually cautious still about taking what I'll call too much income accelerating into the current year. While it's a good deal to get income at this year's rates versus next year's rates if we go off the fiscal cliff, the caveat to that is that's only until we leave the tax bracket that we're in and go into a higher one. So if we draw so much money into this year from Roth conversions, IRA withdrawals, or other things that we take our current tax bracket from 25 to 35, we've caused our own 10% tax rate increase, in which case we would have been better off with the merely 3 to 5% tax rate increase that's scheduled to occur next year if we go off the cliff. So a lot of the income shifting strategies in particular are really about only doing so to the extent that we can stay in our current tax bracket. Now that's not trivial. Some of the tax brackets are more than $100,000 of income wide, and we have some deductions to manage as well. So we can still do some pretty material dollar amounts, but things like absolutely enormous hundreds of thousands of dollars or $1 million Roth conversions that we still see a lot of people discussing, including some of the consumer press, really to us would not be on the table unless you are already in a situation where you are in the absolute top tax bracket already and expect to be there indefinitely. In that scenario, we may still find it appealing to do larger income shifting and acceleration into 2013. But beyond that, it's still ultimately a strategy of income shifting in moderation, not necessarily in extremes, because we can move our tax brackets ourselves more than Congress is thinking about moving them.
Hey, one more question for you, Michael, before we wrap up. We had an earlier question. Would it be possible to summarize some of the planning issues for people whose taxable income is between $75,000 and $200,000?
Sure. So for where we stand, if we're in that middle category between 75 and 125. We still face rising tax rates for the ordinary income brackets, so things like Roth conversions and IRA withdrawals for whatever your spending is going to be next year if you're retired are still appealing and still something that we would be looking at. We still want to stay within our tax bracket wherever we are, but those are relatively wide. A married couple stays in a 25% bracket all the way from 70,000 to 140,000, and then stays in the 28% bracket from 140 all the way up to almost 220. So we have a lot of flexibility there within those tax brackets, but we would still want to accelerate income within that bracket. We would still want to defer deductions to next year if we're heading off of the cliff. So things like your fourth quarter estimated taxes should be paid in the first 2 weeks of January. You might even shift your charitable giving until after the new year if it looks like we're going off the cliff. In terms of capital gains, things like gains harvesting still remains appealing if we're heading off the cliff. But with this too, I would really take the wait and see approach where we want to wait until the last, unfortunately as it stands, the last week of the year, the last few days of the year, and really verify that it appears we're going off the cliff before doing some of that. Because ultimately, if we do extend rates, which is on the table for a lot of people at the $70,000 to $200,000 to $200,000 level. If we do extend capital gains rates for those groups, we would want to go ahead and just keep deferring income, take our deductions this year, and follow the normal path. So that group in particular, anyone who falls in that income range, it's generally an accelerate income and defer deductions environment, but very much a wait and see one to get some sense of whether we really appear to be heading off the fiscal cliff. If we're not, we can still go back to what I'll call normal tax planning, where we just take our deductions now and let our income go.
We still have a few remaining questions, but we're going to have to wrap up the call for this evening. If you do have remaining questions, please feel free to contact us. If you are a Pinnacle client, of course, contact your wealth manager. And if not, you can email us at info@pinnacleadvisory.com or call us here at 410-995-6630. And of course, please have a look at our website at pinnacleadvisory.com. We update the site frequently with information, articles and videos related to investment and financial planning. And as I mentioned before, this webinar has been recorded, and we will turn it into a video and upload it to the site on Wednesday in case you'd like to watch it again, or if you would like to forward it to someone who you think might benefit from the information. So we thank you for your attendance, and we hope you have a good evening.